There are 3,000 ETFs at least in Europe. So how do we decide which one is the best one? In this video we are going to see how to analyze and compare two ETFs to choose the best one. Hey, it's Dario and this is DVD Finance, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. And if you love the subject, please consider subscribing. As you may know now by my videos, I think that ETFs are one of the best investments, especially to people that don't have the time or patience to study the single stocks and to study how to choose the single stocks, because it takes a while. And by while, I mean years. So instead of finding those stocks that will make your portfolio grow, we can just grab the whole market and go with ETFs. But how do we compare two ETFs? What are the things that we need to look for in an ETF? Why do we decide to not invest in one ETF and invest in another one? So even though there are many ETFs out there and choosing one might seem difficult, there are some things that we need to look for, and those things will already cut out so many ETFs. So let's see in this video what these things are. But hey, before we start, if you enjoyed the video, please leave it a like and let me know in the comments down below if you invest in ETF and which ETFs you have in your portfolio. The first thing that I would watch is what the ETF does with the profits. Some companies give dividends, and what the ETF does with those dividends is important. So the ETF can do either two things. One is accumulating, so reinvesting the dividends in the ETF itself, or distributing the dividends, so the profits. And that is done to people that invest in the ETF, of course. So what I would recommend is that you choose accumulating ETFs, especially if you are young. But even if you are old, you probably don't want to invest so much in stocks. So either you are young and you invest a lot in stocks and you want to go accumulating, or you are old and you don't even invest in stocks. So my point of view is that you should always choose accumulating. Of course, for some indices, it's not possible to find accumulating ETFs. Of course, in those situations, we will be forced to choose distributing. But if we can choose, it's better to choose accumulating. Why is that? Because what we want from our investments is not a constant cash flow in, but we just want to increase our capital, our portfolio as much as possible. And we do that by reinvesting the dividends. And so to do that, we can either take the dividends, reinvest it, but before we need to pay taxes, or we can just buy accumulating ETFs that do the work for us, but we don't have to pay taxes on those ETFs, of course. So just be smart and choose accumulating. The second parameter that I would look at is the fund size. In this case, I personally choose ETFs that are bigger than $100 million. That is simply because less than 100 million are really small, and maybe in a recession, those ETFs might even go bankrupt. So just choose the biggest ETF that you can, and also compare other parameters, but as a rule of thumb, don't go less than 100 million. Of course, this also depends on your capital. If you have $1, $2, $3, $5 million to put in a single ETF, you might want them to have 200, 300, 500, $1 billion in fund size, not even 100 million, because having 5 million into an ETF that's 100 million, it's a little bit difficult, okay? It's a little bit difficult to enter. The third most important parameter that I would look for is the age. For this parameter, you don't want ETFs that are less than 1 year old. This is for two simple reasons. One is that you don't have enough history to know if the ETF is doing a great job. And the second one is that you don't have enough history to compare to ETFs. So just look for ETFs that are 1 year old or more. So now these were the three most important parameters, the parameters that every ETF should have. But now, how do we compare two ETFs? First of all, when you compare two ETFs, you need to compare them if they are relevant. So if they have the same index, which is the best thing to do, or if the index is slightly different. For example, you might compare two indices that both track the US market, but they are different. So they are built by different companies, but they both follow the US market. In this case, is also possible. What it's not possible to do is to compare an ETF that follows the US market with an ETF that follows the European market. That it's not possible and it doesn't work. So now, of course, you should already know what you're looking for. For example, I have a whole Excel sheet of my ETFs, and to find them, I basically went in order. So I first looked at the equity world, then I looked at the equity US, and then I looked at the equity Europe, then I looked at the equity emerging markets, and so on. So you could do the same thing. But if you are already interested in one particular index, I don't know, the S&P 500 for example, you can just look for S&P 500 ETFs and then compare those. Please, again, do not compare ETFs that are not relevant. Comparing the S&P 500 with the STOXX 600 is useless, doesn't work. It doesn't make sense. Now, to find ETFs for those indices or for those markets that you want to follow, you can use justetf.com. These are all European ETFs. That means that European people can buy them. As you may know, European people cannot buy American ETFs unless they have the KIID, but that's still a problem for us. Instead, I'm not sure 100%, but I'm quite sure that Americans can buy European ETF. So in this case, we are just going to look at ETFs from Europe. But if you are from the US, you can apply the same concept, but with other websites, such as ETF.com. That is a platform that looks at American ETFs. So the same thing applies. All the rules are the same. We are just going to use justetf.com to make the example. So at this stage, you found the index you want to follow, or you found the general market, for example, the equity world, and now you need to choose some ETFs. As you may see, in this case, we have a bunch of ETFs. We have so many ETFs that follow the world index. So the first thing that we want to do is to remove the strategies. Now there are new ETFs that I personally call beta. I think this is a name that it's common, but I call them that, okay? So these ETFs use a strategy. Of course, they always follow an index, but the index has a certain strategy. For example, you can have momentum, volatility, or value. Those are, for example, 3 strategies that are used in indices and then in ETFs beta. But if you don't know anything about ETFs, I would avoid those strategies. But if you intend to use those strategies, please go ahead and use those strategies. So instead of selecting no strategy, just select the strategy that you would like to follow. At this point, you will see that for the world index, we have still a bunch of ETFs. What we want to do now is order the ETF by the one that costs less to the one that costs more. And the cost of an ETF is reflected to the what's called TER, total expense ratio. This is the total expense that you will have per year on that ETF, and as you may see, it's really low, at least compared to the active managed funds. Now at this stage, you need to select some ETF. What I recommend is to select 4, maximum 5 ETF. From the list, you should already see what are the best ETFs, and to choose them, you just look at the price and at the fund size. You want to choose the ones that have the biggest fund size and the lowest price. Choose 4 or 5 of them. For instance, for this example, I chose the Lixer, the SPDR, the Xtrackers and the iShares. So 4 ETFs that we are going to compare. Now we are comparing the 4 ETFs. The first 2 that I will discard are the Lixer and the SPDR. Why is that? Because they are much younger than the other 2. I prefer older ETF. They are easier to compare and they are more reliable. So just discard those 2 that are younger, because the difference in cost is not that big. So just discard those and let's concentrate on the Xtrackers and on the iShares. In this case, we can see the Xtracker has a slightly lower volatility than the iShare, which is good. Lower volatility is better than higher volatility, but also it's a little bit younger. Not that much. The Xtracker is from 2014 and the iShares is from 2007. They need to follow an index. They don't have strategies. They are not active managed funds. But also, in contrast to the lower volatility, the Xtracker has a slightly worse performance, which is not a big deal, but it's something. And it's something that made me choose the iShare, okay? So I don't care much about the difference in volatility, which is really low, and I'm also happy because the iShare is older, and I'm also happy because the iShare has a more efficient performance. So this comparison made me choose the iShare over the Xtrackers. But choosing the Xtracker wasn't wrong. If you chose the Xtracker, that's completely right. That's perfect. Awesome. Now, if you're wondering what I do now is just input the ETF in my Excel sheet. I have all the ETFs that I would invest in if I wanted to build a portfolio, and the moment that I want to build a specific portfolio, I'm going on that Excel sheet and choosing the single ETFs to build the portfolio. That's it. So this is all I had to say for ETFs. I hope you understood how to choose and analyze an ETF and how to compare to ETFs, which again have to be related. Remember that. Don't do it wrong, okay? So this is again all I had to say. If you enjoyed the video, please leave it a like and let me know in the comments down below if you are building a portfolio made out of ETF, if you already have a portfolio in ETF, and what do you think about ETFs? And I'll see you in the next video. One of the major issues that the society is facing right now is probably water. But here in London it's raining right now. But so why do I say that water is a problem in this society?